Hello, everyone, and welcome to another episode of, I'm going to call it an episode, John's November, in this case, his November retirement account review. I do have a baby with me, so if you guys hear noises, I apologize. He's being very talkative today, but I am on dad duty right now. So, anyway, I'm going to jump into the numbers and take a look and see. We are closing in on the end of the year, and things are looking pretty good. Point out maybe some interesting trends or things like that we've seen. And yeah, any questions that you might have, leave them in the comments and I will be happy to answer them. So, as always, I'm not a financial advisor and I don't claim to be one. And in this article, it does not reflect the views or opinions of my employer. And I do hold a number of positions similar to John, and I do have those listed on the screen. And then this is a real portfolio with real shares being traded. It is not a practice portfolio with play money. So everything you see is actually happening, and that is why I include as many screenshots as possible to help demonstrate the validity of what it is that we're looking at. So the why I do this, I've probably gone over this enough times, but for the people that are new, John and Jane, in my opinion, were being taken advantage of in terms of the fees that they were paying. And when their advisor changed firms, they moved them into a completely different set of mutual funds and charged them load fees all over again. And it was kind of hidden in the numbers. And it was something that over the years I'd built a relationship with John and Jane, having been their finance person or their loan officer essentially. And I liked him and we got to talking about it. And so I've always been interested in investing. I've been writing previously for Seeking Alpha for quite a few years. And the reason why I switched to the YouTube format was because they decided that they didn't want to support the format of the articles that I had. And so, anyway, long story made short, John and Jane decided, let's just take control of our own finances, and that way we don't have to pay an advisor, but then that way we can also have more control over what it is that we're actually doing. And in this case, the goal is generating income. The big concern for both of them has always been, okay, I have X amount of dollars, how do I live off that money? And part of what my strategy for them was to rethink, hey, you have a set amount of money that fluctuates potentially a lot every year. Instead, focus on things that produce income. So then that way you're no longer looking at it from the perspective of I have to draw this much out every year, even if it's a bad market or a good market, and I have to maybe sell shares of a company that I don't want to, or maybe you do want to. But why be beholden to the fact that you would have to sell something in order to get that income, when you can just buy something that you want to hold and keep holding, potentially at least, that produces income, and then you can live off of that instead. It makes it a more sustainable path. And so really the idea here is that I'm asked them, for the privilege to be able to present this information to other people, so that other people that are interested in the idea, or at least considering the idea, can potentially, see what the pros and cons are. So for John and Jane, the quick on their background. So both of them are retired, and they both collect Social Security. And Social Security is the only form of income that they have other than what they have in their retirement accounts. So no pensions or anything like that. But in addition to Social Security, John and Jane are withdrawing $1,700 a month from the taxable portfolio, and then $1,000 a month from John's traditional IRA. And so that's their own decision, that they've wanted to withdraw those funds from those accounts in those amounts. And then they do have other investments outside of what I help them with, mostly, certificates of deposit, maybe some bonds, things like that. Nothing that would be, on the equity side of things. But I think one of the most important factors is that John and Jane do not have any debt, no monthly payments. They own everything that they need, and prior to retiring, they made sure that they had the funds they needed to, buy a new vehicle. They bought an RV. So basically, they set themselves up to make my job as easy as possible, in the sense that they need the bare minimum amount of cash flow and Funny enough, half the time I'm encouraging them to take money because they have, in their conservative nature, they just don't live outside their means. They live very well within their means. So for the traditional IRA, when we compare it to November of 2022, dividend income was, or I should just say income, was at $1,185, and that compares to just under $1,040 in November of 2022. And then in the Roth IRA, it was actually down slightly, and I'll be able to show you guys why in the numbers, because normally we would expect this number to be about the same or go up. At least typically year over year. But in this case, there was some changes in the holdings in the account, and that helps us account for this difference of why it was $520 in November of 2023 versus $585 in November of 2022. And then for the balances in the accounts, you can see that the traditional IRA, at the time of the end of November, that balance was down quite a bit. You'll see in my gain loss tables that situation has since changed significantly. But in the Roth IRA, it was much more steady year over year in terms of being down. It was 211,000 was where it was at the end of November, and that compares to 214 for November of 2022. And there's two companies in John's retirement portfolios that paid an increased dividend or a special dividend during the month of November, and no companies decreased their payouts. So the two increases are from two companies that have been performing actually quite well recently. John Deere, so that was an 8% increase, went from $1.25 a quarter to $1.35 a quarter. And then for Westrock, that was a 10% increase, up from 0.275 a quarter to 30.25 cents, I guess you would say, per quarter. So for Deere, just a quick takeaway, margins remain strong. They had an increase of 16% in net sales revenue year over year. So basically that was the optimistic part. There's a little bit of a mixed bag going into 2024, in particular with the forestry industry and some of those industries, but also like Europe. So there's a little bit of uncertainty, but overall, they remain confident that they're on track for the direction that they've been saying all along that they've been going in their call reports. So, and then Westrock, a little bit more interesting of a situation. So there's the potential merger with Smurfit. I don't think I've seen yet where it's gotten approval from the SEC yet. But they said that they don't expect there to be any issues. The Smurfit CFO mentioned that they're expecting about $400 million in synergies, and all of this merger news was on top of a strong 2023 Q4 earnings that was an adjusted earnings per share of 81 cents a share. Reason why I use the adjusted earnings per share is because there were there was a pension item, and then there was some economic downtime that were the main reasons why for what you'll see is the actual earnings when it came out, but the adjusted earnings tells the bigger picture of the story, and so that is definitely on the strong side, especially when you consider the dividend coverage on Westrock. It makes sense why they were confident enough to raise it by 10%. So for John Deere, you can see here, we haven't held John Deere for a long time, and we don't hold many shares. We actually had recently sold off the higher cost shares, so even though the stock is performing well, we did decide to reduce the higher cost position in favor of this lower cost position that we established back at the end of May. So it's overall sitting at a solid gain, but you can see that it hasn't contributed much in the way of dividends, but that's also because the first dividends we received from John Deere was going to be back in November of 2022. So it does have a lower yield that comes with it, but there is a lot of growth potential. But that's another reason why when I look at a company like Deere, I'm more willing to get rid of those higher cost shares. Because there's a little bit more value that comes from Deere in terms of its ability to increase its market value. So basically what we're getting from the share price over the dividend. So in this case, I'm willing to wait until we see the share price goes down. And then in this case, we also sold the shares. I think it was about $370 a share, if I remember right. I can't remember exactly off the top of my head, but we'll see those numbers here, I think, in a little bit. And then for WestRock, you can see here it had this holding much longer, but the holding and the size of it has increased modestly over the years. We actually did recently sell off the higher cost shares as well, because I think it was about $38 a share was the higher cost piece of it. So now, after we added here back in June, we went ahead and released those higher cost shares, so that now we're sitting at a strong gain on here. But in total, John's collected just under $719 of dividends since February of 2020. And then for the November trades on the traditional IRA, we've already talked about this one a number of times, but Net Lease Office Properties sold off those shares. That was the spin-off from WP Carey, and again, just wasn't interested in having to learn about that company and everything that it held for how small the position it was, so we just sold it off and called it good. And then as you can see here for John Deere, we went ahead and sold off at about $372 a share. Could have held it longer and seen it go higher, but we're always erring on the side of safety when it comes to that. And then for the Roth IRA, saw a little bit more activity. You can see here where we added another CD, and that CD income isn't going to be reflected until December because of when it was purchased. But also we have the sales of WestRock that I mentioned, and this was going to be at about a break even, or at least pretty darn close to it. And then we also sold some shares of Bank OZK. These were not necessarily a high cost position, but we just reduced the size of the holdings. Stock has since gone up quite a bit since then, but part of the reason for selling this and then moving some of those funds or using some of those funds into a CD was just to say that the yield that we're getting on Bank OZK is it's kind of reaching the peak of where I would expect its share price to go. So I'd rather have the cash on hand or invested at something that's earning a higher yield. And then for Apple Hospitality, sold off the 100 shares that are the highest cost portion here. These are shares that have been held for a very long time. I believe they were purchased actually prior to the pandemic. So it was purchased up at the higher end of what their share price was. So we sold these off, and now the remaining shares that we have are all at a relatively low cost basis. And that position has gone from being a perpetual loser when it comes to the gain loss section, and now is sitting at a pretty big positive. Excuse me. And then for November, the realized gain loss here, you can see that. So for John Deere, again, we sold off basically close to what the shares were worth, cost basis of the two being at 738. So what that works out to being, it's like $375 a share. So in this case, made a few dollars. And then for Net Lease Office Properties, made a few dollars here. Nothing to go crazy over, I guess. For Apple Hospitality, we sold these shares off. Could have gotten a little bit more if we held it for longer, but $16.50 was the point where we felt pretty good about being able to reduce that high cost share position, especially since everything else is looking so good. If the stock price drops back down to the $15 a share range, I would definitely consider adding more, because they've been able to restore their dividend for the most part, and then also they have a special dividend payout coming as well. So things seem to be going well with Apple Hospitality. And then for Bank OZK, you can see here that these were going to be at a much lower cost basis. I think that works out to be about $28 a share is what they were purchased at versus sold at 40. Stock prices continued to go up since then. But, like I said, when it comes to the yield of the stock, and then kind of reaching the point where I don't see a lot of upside in the market, or like the appreciation of the stock price, was part of the reason why we chose to sell off, a portion of those shares. And then for WestRock, you can see here, very small loss. It was basically $38 and some pennies was what the original cost basis was on those 25 shares. And that is why we sold them off. So year to date, I think it was on Jane's article that or Jane's video that I started thinking about this a little bit more. But, when we make a sale, basically 89% of the time and 87% of the time, when you're looking at the gain-loss ratio, we're selling at a gain. So one of the reasons why that's relevant is because if we were selling off a lot of losers, and this is part of what I get to be kind of a stickler about, when it comes to the way that these numbers are reported, is that I find it a little bit unethical that people will go in and say, look how much money I made, look at all these sales that I made and these big gains that we got. And in this case, we have sold off some ones that are at pretty big gains, but you can't hide this total losses number. When you look at this gain-loss ratio, right? It's saying that, okay, of all the stocks that we've sold off, we've had $8,322.85 that was positive. We've had $1,055.65 that was negative, and here is the net gain. So if I had a bunch of losers and I was trying to portray that my this portfolio was performing better than what it was, but say I had a bunch of losers that was making, bogging those numbers down, it's possible I could just go in and, when we get to the current gain-loss table, I could just pick all the losers, say I'm going to sell these, and make it look like, hey, look at all these unrealized gains that we're sitting on, but that's because of all these realized losses that we took. So it's just, it's one of the ways that I think people can potentially hide things in the numbers. And so that's part of the reason why I like to show this every single time, is that, basically 85-ish% of the time, when we sell something, we are selling it at a gain. Okay. So hopefully that makes sense. Let me know in the comments if it needs further clarification. And then as far as the year-over-year changes, so there was a modest increase in the size of healthcare realty for that position, and we know it because the dividends increased even though they haven't raised the dividend. And then OzCap is the preferred shares of Bank OZK, and we increased the size of that position as well. And then Masco and then Oshkosh were two companies that were eliminated from the portfolio. Mainly with Masco, it had to do with the I would call it the renovation economy. So the Home Depot economy, the Lowe's economy. They're selling a lot of bathroom fixtures, things like that. And so in my estimate, it was just a good time to get out, because I do have concerns about people's ability to be able to keep taking out debt and paying for renovations and things like that. And then for Oshkosh, they had actually suffered in their stock price for a while, and that's why we were able to buy it at such a cheap price, because of some issues with delays in getting parts, and then their delays in being able to actually build the machinery. But it seems like those have been resolved. Their stock price went up quite a bit, but it was a small enough position and a small enough dividend yield that I wasn't too keen on necessarily continuing to hold those shares. So PacWest gave its final payout. It's since been acquired by Bank of California, so that's going to be reporting under a new ticker symbol next year. So there's still going to be dividends that are received from it, because we did choose to continue holding those shares, at least in the short term. But it won't be reporting under PacWest Bancorp anymore. And then CD interest was earned for the first time in November. And then remember that this CD interest is going to actually be about double that moving forward, because in the month of December, you'll be seeing CD interest from the second CD being received. And then for the Roth IRA, so the Apple dividend cut, you can see that it's continued to grow after that. This dividend is going to go down, though, because we got rid of the 100 shares. And so just be aware that it's going to look like it was reduced, but it was reduced simply because we got rid of some shares. And then one of the big factors I mentioned at the beginning of this was that Rhythm Capital, and this is preferred Series B, was eliminated from the portfolio at a slight loss. It was basically in favor of reallocating capital to less volatile fixed income investments. So we have some exposure to Rhythm Capital in the taxable portfolio at a really, really low cost basis. And basically they are holding mortgage-backed securities. And so on this one, it was just in favor of, with where rates were going, putting that money into a CD instead of having it in the preferred shares, was something that made sense at the time. And then as far as shares no longer held, there was also $75.60 that was earned in November of 2022, and that was from General Dynamics, and General Dynamics was eliminated from the portfolio. And then the CD interest was earned for the first time in the month of November in the Roth IRA. So the full year-over-year comparison, we're looking at a negative 6.3% increase in income from the traditional IRA, but that is improved from negative 7% that was estimated to be in the month of October. And then the Roth IRA has been on an absolute tear when it comes to the increase of income. And even though the month of November was down, it was actually up from what my original estimate was. And the big reason for that, I believe, is going to be because of the CD income, because if you remember this third bullet point here, I do not factor in CD income in these yellow estimates due to when they end, and just it's too much work for me to keep track of. So I'd rather err on the side of safety, pretending that income doesn't exist, so that it can make things look better than what I'm purporting them to be, or at least stating that I expect them to be. But it was expected to be up 16.7% in the Roth IRA, and that is up from 16.6% in the month of October. And then on the account balance, we're looking at they're down considerably compared to November. Well, at least the traditional IRA is down considerably compared to November of 2022. The gain loss table that's going to be in a couple of slides, you'll see that this has since been reversed significantly going into the end of December with the rally that we've seen. But one thing I do want to point out is that in John's traditional IRA, since we do draw out $12,000 right now, so $1,000 a month, $12,000 a year, that the difference of negative 27,000 is really closer to about negative 17,000 year over year if we add back in that $12,000. So that $12,000 is money that was real. I'm not saying that we're adding it back in like it's an accounting thing. It's just to say, where would the portfolio be if John hadn't drawn out those funds? And then for the 6-year comparison on the traditional IRA, John's has the exception to point out where in 2022 we saw a huge dividend increase, and the big reason for that was $2,400 of dividend income received in July, and that was from the acquisition of Healthcare Realty acquiring Healthcare Trust of America. That's it. And then, but if we back this off, the total dividends in 2022 would have been about $15,427.52. So when you see here that we're looking at negative year-over-year dividend growth, again, I'm always trying to report on things from the absolutely least positive way possible. And the main reason for that is because I just really get frustrated by people being disingenuous about the way that they talk about things, especially when it comes to their portfolio. And so I'd rather just err on the side of safety and then add a caveat in here. So I'm still going to leave the dividend income the way it was, even though it was a special dividend, because I think I think it's just better to report that way. But if that special dividend had not occurred, then we would be looking at a year-over-year increase of about 8.2%, which is pretty darn solid. And then also, I'm going to add this on Jane's articles as well as the taxable articles, is that the portfolio is a 5-year dividend CAGR of, and that's cost, what is it? Cost of average goods returned, I think is the acronym. I can't think of it off the top of my head right now. But basically, over 5 years, if we take all of this dividend income and average it out, we're looking at about 14.6% growth year over year. So that takes the good years, here, and then the bad years here, and says, on average, over 5 years, we have seen the dividend payouts grow by about 14.6%. And did I? So I apologize. I'm going to have to go back to the Roth IRA here. I must have switched the slides. But on this one, same thing on the Roth IRA, with the exception of we saw losses back during COVID, and then the year after COVID, because it was particularly impacted due to the real estate investment trust companies that are in this portfolio. But even with those setbacks, we've been seeing basically it's around 12.4% year over year growth. So that's also been a big positive when we look at it from that perspective rather than just on a year by year perspective. This is the slide that I must have accidentally switched the slides. But the cash balances in the account, this is just as of the end of the month of November. But one thing to point out is that John currently has about does have $45,000 in CDs, and then has $15,000 in Charles Schwab money market, and then another $35,000 in cash between the traditional and the Roth IRA on hand. And so the reason why there's a delay in the cash amounts that you see here, which add up to about 40,000 versus the 35,000, is because that 35,000 is what was had at the end of, as of December 22nd, 2023. And then now to the unrealized gains portion of it, you can see here that the Roth IRA, it's been pretty ugly this year, consistently being in the negative. But this is also a screen that I think is important to help paint the picture of this year would be considered a down year. The last time we had a down year, and remember with the Roth IRA, there's no money being drawn out of it yet. But the last time we had a down year like this was during 2020, and that was, as you can see, initiated by the COVID scare that occurred. But even though we have seen this level of volatility, or at least what a lot of people I think would consider a scary number of seeing something sitting at a loss, this does not take away from the reality that the Roth IRA produced, more income year over year. And in this case, if we use the 5-year CAGR number, then we're looking at about 12.4% year over year income. So even through the good years and even through the bad years, it's producing over 10% more income every single year. And I think that that's something that more retirees would benefit from, because the thing about finance and what I probably don't talk enough about is the relationship to stress and rising cortisol levels, and it's one of those things that tends to be like the unspoken relationship between your finances and your personal health. Is that if you're stressed all the time about your finances, that's not going to contribute to good health. But if you find a way to say ignore the noise, and in this case, as you can see, there's a lot of noise between the unrealized gains of both of these accounts, the reality is that income is still going up every single year. Well, if income's going up every single year, then why are you so stressed out unless you're living outside your means, something along those lines, right? And then, as you can see, there's been a lot less volatility if we average it out in the traditional IRA, but still something that I would say is an unnecessary stress inducer, because the CAGR for this, the 5-year dividend growth, was sitting at, I think it was 14.6%, if I remember right. So even though things might not necessarily be looking like they're going stellar, it's producing a bunch of income that can be lived off of. And then this goes to the withdrawals here. So John's continued to receive $1,000 a month, even though his traditional IRA as of the end of November was set to generate just under $1,400 a month of income. And so this goes into what I'm talking about, which is being able to live on less income than your portfolio produces is the best way to ensure that you're able to produce income to sustain you over time. If there is a portfolio where this is the most important thing, I would say that it's going to be the traditional IRA. And the reason why I say that is because it all has to do with the RMD. So your RMD is what you're required to take, and that is a government set mandatory amount based on the amount that you have invested and your age. And so if you don't have your portfolio set up where it's generating income like this, where it exceeds what you need to draw out, then the sad truth is you're going to have to start selling shares. And, to be clear, you are going to have to sell shares out of your traditional IRA at some point in time. Unless you die and leave it to a family member, and even then they're going to have to sell it. But there is no point at which you won't have to sell shares from your traditional IRA. The key is that you want to sell off those shares, hopefully as late into your life as possible, so that you can continue living off the income. Because if you're selling off shares, you're getting rid of balances. If you're getting rid of balances, you're getting rid of potential income. So in this case, even if we use the high balance of $352,000 at the end of 2022, which is more than what's currently in the account now, John would be required to draw out $14,111.48, and that's about $1,176 a month. And as you can see, that is still less than the $1,391 a month that he is generating. And then for this table, it is, to me, the most important table because it kind of wraps everything up that we've been looking at together and is the most current view. In this case, all the numbers are accurate as of December 22nd, 2023. And in this case, you can see that John's RMD is easily covered by, well, that's an old number. I'm not going to go back and remake this part. But it's now up at $16,197.70, as you can see down here. And his portfolio is generating on average about 5.53% based on the cost basis here. Just know in this 5.53% number, that does include the shares no longer held for the full year of 2023. So it's not just this 16,197.70, it's all the other shares where dividends were collected, but now no longer exist in his portfolio. And then for the Roth IRA, very similar situation here where the 4.55% is going to include all of the dividends that have been received on companies that are no longer held. But one reason with the Roth IRA why it's been performing well and it's been producing a lot of dividends. But you can see here that this is the CD that we just added, and that income has not been factored in yet in the month of November because it's not going to be received until December. So it will show up on December's report. But here you can see that it's still sitting at just a slight loss as of the 22nd of December. So the market continues to do what I consider continues to move in a direction of what I consider to be an unwarranted rally. I've mentioned in prior videos I have major concerns about the auto industry, and then the ripple effect that has, and I'm not going to go into that again because that's just basically a rant I'm going to get into. But also, when you look at the current gain loss tables, yeah, there's timing delays, but don't let that take away from the point, which is you see volatility, and then I'm trying to present the data in a way that helps people see that you could try and view your portfolio from the perspective of it's volatile and when do I draw money, and add in all these variables. The more variables you add, the more complicated and more stressed out it's going to make you. So the key here is to find variables that are easier to control for, which is, has this company always paid a dividend? What is the typical yield that this company has paid on that, right? If you see patterns of companies, where they've paid dividends for, 10, 20, 30 plus years, and they have a safe payout ratio, then chances are it's going to continue being good going forward. But if you're investing in companies where there's a lot of volatility, and by the way, there are some in John's portfolio, those ones require a significant amount of dedication to reviewing the numbers and understanding the business model. And those are going to be ones that I would strongly urge people to think about, is this something that really makes sense for me to continue holding? Because if you don't understand the risk, then it's likely that it's going to become a problem for you at some point in time, which then leads to stress and makes my point. So for the traditional IRA, John's going to be required to draw an additional $2,111.48 before the end of the year to meet his RMD. And that's actually before April 15th of 2024. But the RMD, as I mentioned before, based on your age, the year-end balance of the previous year, and then that is going to determine how much you need to draw, and there are calculators that are available for that. So just to summarize everything, a successful dividend income portfolio will generate as much free cash flow as possible in an effort to cover the RMD as long as possible, in this case specifically for the traditional IRA, and the ultimate goal is to not have to sell shares unless it's absolutely necessary. A good comparison here is when you think about the Roth IRA, that John could literally go his entire life and never draw a single penny off that Roth IRA. Same with Jane. There is no rules that say that at a certain age you must draw funds off of it. Now, when the time comes that they pass away, and that portfolio goes to their kids or grandkids or whoever they want to leave it to, then that's going to be something where then funds will end up needing to be drawn out of the account. They could basically continue to generate cash from there, free and clear, or they could even continue to draw the income from there, leaving the investments alone, and basically create what would be a pension until they die. So income, as long as it's always producing income, then it's always going to be tax-free income. And if it's going to be tax-free income, then there'd be no reason to draw that money out of that account unless they actually needed it or wanted it. I usually tell people that if you're looking to make a big ticket purchase and you have enough funds in your Roth IRA, and you don't want to finance, like say you'd otherwise be required to go, take out a loan or something like that, then I would tell someone to draw it from the Roth IRA, because if you have $30,000 sitting there, and you can avoid, right now car loans are at 7.24%. If instead you can just draw $30,000 out, and that's just cash that you have, then it's tax-free and it doesn't impact your income, and then you don't have to take out a loan. So that would be my 2 cents on that. But any questions, comments, would love to get some people's thoughts. Also, if there's anything I can be doing better, I try to make these videos as short as I can, but obviously at 39 minutes where we're at right now, that's not going so hot. But I would rather include more information and have the videos be less popular than to not include enough information and have the videos, come up short. So anything I can do to add value, let me know. Thanks everyone for watching. I appreciate it.